It is 8:04.
8:04.
If we can stand for the Pledge of Allegiance.
Pledge
Allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Just a quick roll call. Start with Mike.
Here.
Neil.
Here.
Dave.
Michael Shostak.
Here.
Jason.
Divels. Yeah, okay. Public comment. Hearing none, we'll move to, for a motion to approve the minutes for May 7th.
So moved. Support.
All in favor?
Aye.
Aye. Any opposed? None. Approved. And quarterly portfolio review, so I'll turn it over to Brian.
I'll just jump in here for the operating reserves. So, March 31st is our high water mark because we've just collected all of our taxes. But we had a strong quarter in terms of our holdings. We ended with $85.8 million in operating reserves or operating funds as compared to $73 million in the year-ago quarter. We're currently holding it in our checking accounts, some in money market funds. We've got a little over $7.3 million in bank CDs, $29 million in the MI class local government investment pool, and over $45 million in fixed income securities, all government or agency bonds. And we generated $664,000 of interest in the quarter. Most of that interest, so our interest is kind of lopsided between the June and December quarters versus the March and September quarters, because more of the bonds pay interest in the March and September quarters. So we're going to see a big difference. So we had $1.4 million in interest, for example, in March 31st quarter versus the $664 last quarter. So on the rate side, rates haven't come down as quickly as we thought they would. So we're continuing to generate some good interest on that. So unless there are any questions on the operating reserves, I'll turn it over to Brian to talk about the pension plan.
All right, for the sake of those that heard the tail end, I'll amend the jokes a little bit. I've always talked about trying to find the right kind of way to tell the story of the quarter. And the best example that I can give is, so I've talked about, it's like I've got an 11, 10, and 6-year-old at home, and they're having this summer like of dreams, right? Like summer camp, golf camp. They're at rock climbing camp right now. I'm like, I had like a bike and a hose, right? Like and go away and come home when the street lights come on. So in the era of parenting, what I have for you today is not disappointment, but like you're going to be not as happy as you could be, right? So great quarter from a capital market standpoint. We did very well, but we did not do as well as we could have. So that era of like my kid's doing a fun thing and he's like, well, what's the next good thing? So I'll take you in. I always love starting with this page 6, bottom right-hand corner, or the bottom line. If we go back to April of 2014, the DB portfolio was worth $84.2 million. That was based on the Township's decision to bond, right? So we traded an unknown liability from a pension standpoint for a known liability from a debt issuance standpoint. So that arbitrage is, can we make more money in the equity markets or in the capital markets than we pay in interest? $84 million value going back 11 years ago. We've had net cash flow of $34.2 million out. So that's assets transferred out of this investment pool and into the guaranteed account to pay benefits. We have had a $72.1 million gain, right? Stock price goes up, dividends, interest, income payments from the real estate portfolios to the value today of $122 million or an 8.66% return. So we could end the meeting here from the standpoint of, has the DB portfolio been successful? Yes. Was the decision to issue debt to fund the defined benefit promise a success? Yes. Now I'll keep going. Top of page 7. So as I'd mentioned, be happy, but maybe not as happy as you could have been. The overall DB equity portfolio returned 8.2%. For that same time period, equivalent index returned 9.7%. That delta may change a little bit. Now that we have allocations more sufficiently built out to Bloomfield Capital and Capital Dynamics, we need to adjust that total fund index just to account for the fact that those aren't in the Russell 2000 or in the S&P 500. But first quarter of the fiscal year for the township to have north of an 8% return, I think is a great start. Again, happy, not as happy as we could have been. I'm going to change the order. I'm going to flip you to page 8 and work from the bottom up. So as I'd mentioned at the end of the last meeting, we were showing zeros for Capital Dynamics just because of the timing of their statement issuance. So their December 31st statement would have come in late May, again, just based on the timing of things. That portfolio since October of last year, so 10 months in, is up 28%. That's the beauty of buying secondaries, so buying existing private equity funds at a discount to their current value. So great start. I want to temper expectations. The long-term view on this is kind of 15 to 16%, so that gap will close a little bit. But it's always nice when you have a new private investment added to the portfolio and we say right out of the gate it is in line, if not above expectations. Same story with Bloomfield Capital. If you go up, added back in October of last year, recall they are providing loans backed by real estate, right? Apartments, retail, office, industrial, on the smaller end of the market. They are paying a 7.5% coupon right out of the gate, so money that went to work in November and December of last year. In Q1, we got our first distribution. In Q2, we've got another distribution that's at an annualized 7.5%. So they are doing exactly what they promised right out of the gate and even doing a little bit better. So again, nice with the private investment to see that. The other two pieces from a real estate standpoint are Principal and TerraCap. They have not yet priced for Q2. Based on initial estimates we've gotten from Principal, I expect that to be a 1.4% return. So outperforming and continued positive news. You're seeing commercial real estate markets start to unthaw. And TerraCap, based on some of the appraisals they've done, they do 25% of their properties each quarter. And based on initial conversations, they said we expect a write-up in the second quarter when we finalize those numbers, because the appraisals we've done on 1/4 of our properties are up from where they were a year ago. Most importantly, I think, is they've taken a conservative approach. They don't take that 25% that they've appraised and say, we're going to apply that to everything else. They say, we're only taking the write-up on the properties we've appraised. What we do in the third quarter, if those are up, those are the only ones impacted by it. So they're not applying this quarter's appraisals uniformly across the entire portfolio. We see a lot of managers do that. A little bit more of a conservative approach. Emerging markets, single best performer in the portfolio for the quarter, up 14 and change. Recall ABS is built a little differently. So they are comprised of 20 to 21 underlying managers. So rather than deciding from a trading desk somewhere in the US, what's the best stock I want to buy in South Africa or in Argentina, their teams are operating in market and identifying the best Argentinian stock pick, equity manager. The same vein that we go through and we're like, okay, we think for large cap value as a US investor, Ancora is one of the best. We're a US based investor evaluating US based investment managers. They follow that same mentality. So they were benefited by stock selection in Taiwan and in India. And then one of the premises there is because they're operating with local in-market investment managers, is they're buying a lot of small and mid-cap names. Right, a lot of kind of local stories, local impact, local to each of those countries and their economies, and that was another great driver. So 2% outperformance for them, and the single best performer so far for the fiscal year. Fidelity International Index, no surprise, up 11.7, right in line. International equity markets continue to dominate, up 18, 19% so far for the year. Just as we've seen a shift away from U.S.-led dominance from an equity market standpoint to international. They've still got a long way to go to catch up, given the run in the last 10 years. But it's nice to see that story of diversification works. Back to page 7. I'm going to make you bounce around because I'm going to end in the middle with Clarkston. Right? Ancora, dividend-focused portfolio, up 5.2% versus benchmark up 3 and change. You know, the story here was what hurt in Q1, which was Broadcom and Microsoft, helped in Q2, which was Broadcom and Microsoft. So not a lot of changes from one quarter to the next, just a shift in kind of leadership and recognition that these companies are doing what they should be doing, and stock prices have been rewarded as such. Second best performer was the Fidelity S&P 500 Index Fund, up 10.9%, right in line, no surprises there. Another strong performer was the Fidelity Extended Market Index Fund, up 12%. Some of the biggest drivers for performance there were names like Robinhood, Carvana. I'll go back, if you don't have kids of a certain age, Roblox, you either know what that is or think it might be an offshoot of Legos. It's a money pit as a parent, if you allow it. Really big drivers of performance. What's interesting is those are names, because from a balance sheet standpoint, they're in pretty rough shape. We're not in Reinhardt or Clarkson's portfolios. And for example, you know, small and mid-cap stocks are essentially flat so far for the calendar year. Carvana and Robinhood, those two names alone account for 2% of the benchmark performance. So Reinhardt, you know, was up 5, benchmark was up 8.6. 2 of that 3.5% underperformance is because they didn't own 2 names that if they did own them would result in termination, because they just don't fit the quality standards for how they build their portfolio. The other driver of Reinhardt's underperformance was names that helped in Q1. Kind of the same story. What helped hurt. What hurt helped is Lantheus and Insperity, and they're an outsourced kind of medical diagnostic firm and an outsourced human resources organization. What we'll end with is Clarkson. Clarkson was down 3 and change for the quarter. You know, as I'd mentioned, it didn't own Robinhood and Carvana. Okay, that takes them from being down 3 to down 1 from a relative performance standpoint, but benchmark was up 8.6. Continue struggle. We are scheduling an onsite in the next couple weeks to have a deeper dive, much the same as we did in January after a very, very difficult calendar year 2024. You know, 10%, 11% behind the benchmark isn't a phone call. That's definitely not a Zoom meeting. That's a face-to-face conversation around help us understand what happened. You know, for them, it was a combination of a couple names they didn't own. But the bigger dominance was a couple of names, you know, 2 or 3 names that they did own. And when you have a 4 or 5% position in a stock that just moves against you, you're going to see, you know, an 11 or 12% underperformance. So as I'd mentioned, and some of you may have heard kind of at the tail end of the retiree healthcare meeting, say clients are kind of into like a third gap. Those that have a long-term history with them, you know, predating 2019, 2018, that saw some of the banner years have said, we'll be patient. A third of them have said, we're out. I can't take this level of volatility. It doesn't matter how great, you know, next quarter might be or 2 quarters from now might be. I can't as a personal, like I can't as an individual. And I recognize the decisions are kind of a collective body, but it's representative of what we all bring to the table as individuals is saying, I can't. It's just not something that I'm comfortable with, even as a long-term investor. And a third have said, we're going to give them a quarter, 2 quarters and see some recovery. We haven't seen it in July. They were about 2% behind. You know, I looked like through Monday night. You know, they were 2% behind for July and the first part of August. You know, 35 days does not a track record make, but sometimes there's that, oh, hey, they're 6% ahead so far this quarter, so maybe I will give them a little bit more patience. But we haven't seen it. Michael and I have been in an ongoing healthy dialogue around, you know, other options to consider in this space. Do we move it to an index fund? Do we move it to another active manager? Kind of what's that best option? That healthy conversation was even going late last night, which is something I appreciate. Not the late night conversations, but the depth and intensity of the conversation. How about that? So I'll wrap it and then go to Q&A. Like, this is one of those quarters of you should be happy, not as happy as you could have been, and there's definitely areas for improvement, which I wrap it up with. It kind of feels like parenting sometimes, where you're like, good job, you probably could have done better, but let's have a conversation about it.
Any questions? Any questions from the committee?
Oh, just comment on
Or comment.
Clarkson. Clarkson, I know they've pretty much been on a watch for a long time.
Yeah.
And I do recall when they had the visit last time. And we've been really patient with them, and thank you for, monitoring how they're doing, how they've done in July and, first part of August, because that would be helpful. If the trend was that, okay, they're moving up and things are improving, maybe they get another quarter. But I think personally that it's time to move on, and I've certainly been of the opinion that we be patient with them over the years, because they have produced previously, but based on the most recent track record and lack of improvement, I'm certainly in agreement that it's time to look for other managers.
Any other comments or questions regarding Clarkston Capital? So, as a committee, I know we don't vote, it's a trustee's position, but should we give a consensus from what the committee feels? Should we take a small poll? Do you think it's all right, is can get the feel for how many people are in favor for moving on to another choice at some point other than capital? All in favor of that? Can I get a yay?
I'm in favor.
Okay.
Yep.
Any opposed to that? No, so we kind of got the feel from
Okay.
the committee. Thank you.
What's the feel from the committee on, should we be focused on another active manager, or do you want to look at an index fund?
I personally look at the index fund at this stage.
Okay.
So I'm comfortable with the index. I do like the blend of active and passive. So I think looking at the balance when we're finally done and blending it in with somebody's probably a good idea. I know there was a couple of good choices at the previous meeting that maybe would be similar to here. So I'd like to see those, at least be presented them, kind of compare them. But I think either one's a good choice,
Yep.
my opinion.
I'm in agreement. Index fund's fine for now, but at the same time, I'm actively looking for a manager moving forward.
Do we want to move some of the money into Reinhardt in the meantime? Or are we satisfied? So Reinhardt's at about an 8.6% position right now. Clarkston's at 5.7%, so obviously that's,
I personally would keep it into the index, just
Okay.
because once you start getting over
I would do
5%,
that too,
it just,
yeah.
you're betting on somebody.
okay.
The index is well managed, so it's a good,
Can you just move the microphone closer?
yeah, the index is well-managed index fund, and I think it'd be the easiest and probably the most prudent step.
Okay.
Any other comments or questions? No? Thank you, everyone. On to the defined contribution plans.
Yeah, so we've had good quarters in both of the plans. Obviously, as Brian said, this was a strong quarter for the equity markets as a whole. We're up to a little over 25 million in the 401A retirement plan and almost 35 million in the 457B plan. One item that I will notify or for your information, at the last meeting of the Board of Trustees, the board approved modifying the 401A plan to allow for participants to buy annuities using their funds. And so what this allows now is for our 401A retirees, of which we're going to start seeing some in the coming years, be able to convert into a pension. So when we talk about it with the employees, we're going to call it a personal pension, and they're going to be able to convert all or some amount of their assets into a annuity from TIAA, which as a nonprofit does a lot of government and schools, obviously, and so we have a good product that will allow the employees to get the lifetime income that they didn't get by us not offering the pension anymore. So as we go through union negotiations, of course, we're hearing bring back the pension, bring back the pension. Fiscally, that's just not possible for us as a township. But I thought that by offering this lifetime income option as part of the 401A and 457, it's available to both, that we can give them a flavor of a pension if they want it. It's totally voluntary. So no one would be required to do anything. They could keep their 401s exactly as they were designed, which is, a large nest egg, and they can draw down however they see fit. So I think that optionality will really be attractive to the employees. Any questions on the defined contribution plans? Okay.
Custodian update?
Yeah, so, as I'm sure you recall, we went to bid for new custodian for the pension plan, the retiree healthcare plan, and our operating reserves. And US Bank was the initial best bidder in terms of their financial, the economics of their proposal. As we got into the due diligence, Public Act 20 requires a custodian of township funds to have a physical branch within the state of Michigan. US Bank does not have a retail branch within the state of Michigan. They have a couple of offices for commercial lending and some trust work, but I couldn't get our legal counsel comfortable with that, and so we had to disqualify US Bank on those grounds. And so we went back to PNC, Brian did, and we got them to beat US Bank's offer. So PNC Bank, which as you know has lots of branches here in Michigan, came in actually lower than US Bank's offer. And so we accepted that, went through the process, moved everything over. I think it was a very smooth transition. I'm very pleased with the service that they've given us so far. I like their technology platform much better than our prior manager. And so that has, gone very well. So just wanted to update the committee on that. Any thoughts or questions on that issue? One other thing, I want to go back to the pension plan. So, and Brian, so we have we're only at 8%, a little under 8% in our real estate allocation. Our target is 10%. Mm-hmm. And we're a little under, we're only at about 2% for our alternatives. That target is 5%. So, and I'll open it up, ask the committee as well, their thoughts. Do we want to, the target is the target. We have room in the band around the target, but do we want to look at another alternative to bring in to that slot? Do we want to find another real estate? Real estate's kind of iffy right now. I don't know that we want to double down on that. Do we want to take that allocation and bring it in and combine it with the alternative and have like $5 million that we can invest in a new alternative? Because we are underweight on our alternatives, and we're overweight on our equities right now. So what's your thought on that?
Yeah, so I can say from from a real estate standpoint, while we're seeing signs of hope, we're not rushing out and making new allocations. And I'll give the easy example that I can give is like Principal. So Principal is an open-ended, perpetual real estate portfolio. So you can raise your hand on a quarterly basis and say, I need $500,000, I need $1 million. The problem is they have the opportunity to put up redemption gates, which means you can raise your hand and wave it as vigorously as you want to, and they can say, it's not in the best interest of the other investors for us to sell anything. We haven't seen any redemption gates come up on any, private real estate funds that offer some form of liquidity. So for us, until we start to see those gates start to lift, that is really the sign around, okay, things have really unthawed and we're getting back to kind of normal transaction volume. Real estate managers shouting from the rooftops that this is the absolute best time to buy. But they're fundraisers and we're investors. Their job is to raise assets and our job is to decide what's the best investment opportunity that we see right now. So we're taking phone calls but not making allocations. On the alternative investment side, we're close to a couple different options. You know, on there, it's a very, very cautious addition because unlike, and I'll use Clark's as an example, you know, we're in a separately managed account. We'll be out today. Maybe tomorrow at the longest. But if we make a commitment to an alternative investment, you know, that's a 7 to 15 year commitment. So we're I think, overly cautious about best fit, best opportunity. So that's to come. The flip side of that argument is I'd say, you know, your reward for that patience is the money we didn't have invested in another alternative investment was in the S&P 500 and the Fidelity Extended Market Index Fund, and they made somewhere between 11 and 12% this quarter, right? So it's not sitting in cash waiting to be put to work. It's invested in other parts of the portfolio.
Right, we set target allocations in our investment policy, and I just wanted to know how strictly the committee feels we should be following those, because as it stands compared to our targets, we're over allocated in equities, under allocated in alternatives.
I think the important part is recognizing it, right, knowing we have a plan. I would err towards getting to the targets sooner rather than later, but having caution with, I don't like to time the market, but I'm more of a contrarian. If rates come down at the end of the year like they think, then everybody's gonna go, we should be in real estate, right?
Yeah.
And so now we're chasing it. So I think if you're buying good quality over 7 to 10 years, it's gonna work itself out. You're never gonna pick the bottom or the top, so work towards the allocations because that works over time.
Sure.
But if we don't have any investments at the moment, then we would just wait for those to come in at the right time.
Agreed.
I would not be in favor of going there rapidly. I think that we have, especially given everything else, if you look at what's happening, I would take a little bit more conservative stance in getting there, but I agree with you. That we can look at it and as we're able to move that direction.
Okay. So what I'm hearing is we're comfortable with where we're at right now, and we're gonna remove Clarkston and move the money into the Fidelity Extended Market Index Fund.
Yes.
Correct. Okay. I think number 7 is new investments. I think
Right, so that was kind of
kinda
what
covered
we,
that,
yeah.
I just want to make sure.
I mean, do we want to ask for next meeting for Brian to come back with some alternative options?
I think we should. I mean, if there's nothing on the lineup, that I don't want to force it, but
Right.
if there's things that you've been
Yeah,
vetting.
there's no shortage of opportunities. And
Right.
one of the best examples that I can give is we have private real estate managers that are in the market right now raising capital. And they have held a closing. So they've admitted investors into the fund. And they don't get paid until they put money to work. They haven't made a capital call yet. So even those that have dry powder, we're seeing are just waiting a little bit longer. Because a lot of those were over the mantra of, you know, in 23, they're like, we'll just survive until 25, and we're going to see rate cuts in 25. And we haven't seen any cuts so far this year. You know, press this morning has us a 50-50 split between a 50 or 75 basis point cut in September. So it's coming. But, you know, Fed Watch hasn't exactly been accurate so far this year on rate cuts. But absolutely, we'll keep moving forward.
Especially on the alternatives, you know, we're way underweighted.
Yeah.
Yeah, I'd like to see some things next quarter. if
Sure.
we have them. Any other questions or comments from the committee? All right, I'll adjourn the meeting at 8:34.
Next meeting Wednesday, November 5th at 8 a.m.